Let me describe a moment you've probably lived. You're 22, maybe 23. You've just landed your first real job. You're sitting in a sterile HR office, and they slide a stack of papers across the table. It's your 401k enrollment form. You see the word match, and you think, free money. You hear the phrase tax-deferred growth from your manager who seems to have it all figured out. So you check the box for 6%. You feel a surge of pride. You're an adult. You're being responsible. You're playing the long game. Fast forward, you're 35. You log in, see the balance slowly climbing. Compound interest is working. You're 45, the number looks serious. You're 55, it's finally getting real. The hate 65. Retirement day. You've waited 43 years for this. You click withdraw for the first time, ready to enjoy the harvest of a lifetime of discipline. And then a quiet sinking feeling sets in. Something is off. The math feels thin. The freedom feels conditional. But what if I told you that every single dollar in that 401k isn't truly yours yet? What if I told you that tax-deferred is the most expensive loan you'll ever take from the government? But what if I told you that locking money away for 4 decades was never a strategy to build your wealth, but a guaranteed system to ensure their future revenue? This isn't just saving for retirement. This is volunteering for a 40-year liquidity prison. My name is Bobby, and I spend way too much time thinking about why systems that are supposed to help us build wealth so often end up trapping it. If you're someone who has been dutifully maxing out your 401k, but still feels a knot in your stomach when you think about retirement, or if you've ever looked at that 6-figure balance and wondered why it doesn't feel like enough, or if you've questioned why you can't touch your own money without a penalty until you're practically a senior citizen, make sure to hit that subscribe button. Because today, we aren't talking about getting the match. We are talking about the catastrophic math behind America's favorite retirement plan. We're talking about why the 401k is broken by design. In my berets of planning, the universal advice is deafening. Max out your tax-advantaged accounts, get the tax break now, let it grow for decades. That deferring taxes is the smartest financial move you can make. But that advice ignores one fundamental truth. You're not getting a tax break. You're getting a tax loan. And in 2025, with national debt exploding, that loan's interest rate is about to skyrocket. To understand why, we have to go back to 1978, Washington, D.C. The Revenue Act is being drafted. Buried on page 338 is a 19-word provision, Section 401, added by a benefits consultant named Ted Benna. He wasn't trying to revolutionize retirement for the masses. He was looking for a tax loophole for highly paid executives to defer their bonuses without the restrictions of corporate pension plans. The provision was so obscure, most lawmakers voting on it had no idea what it was. The IRS didn't even know how to handle it. But by 1980, Benna had an epiphany. He realized this obscure rule could be mass-marketed. He designed the first plan for his own company. The IRS gave a hesitant provisional approval in 1981, and the dominoes began to fall. First, corporations saw a golden opportunity. They could shift from defined benefit pensions, where they bore all the market and longevity risk, to defined contribution plans, where you, the employee, bore all the risk. The pension died, and the 401k was born. Then came the match in the 1990s, a sweetener to make the bitter pill of risk transfer go down easier. But that match often vested over years, acting as golden handcuffs, keeping you loyal while the company offloaded its obligations. But then the 2000s brought target date funds, the ultimate set-it-and-forget-it pacifier. But their average fee was zero. 65%, more than 20 times the cost of a simple index fund in an IRA. And auto-enrollment. Participation soared, but default contributions got stuck at a poverty level 3%. Here's the final outcome. What started as a tiny tax loophole for rich executives morphed into America's primary retirement system, shifting trillions in risk from corporate balance sheets directly onto yours. The lesson, the 401k, wasn't designed by retirement experts. It was designed by tax lawyers and corporate accountants. This created what I call the intergenerational tax transfer, your savings ensuring future government revenue, not necessarily your independence. Now, you might be thinking, okay, Bobby, that's a nice history lesson, but how does that apply to my actual life in 2025? Well, look around you. This dynamic is everywhere. Tech, Let's take Sarah. She's 32, making a solid $95,000 a year. She's doing everything right. She maxes her 401k at $23,000. She feels that immediate relief on her paycheck, the tax savings. She pictures that money compounding for decades. Fast forward. Sarah is 65. Her 401k has grown to an impressive $2, $1 million. She starts withdrawing. And every single dollar is taxed as ordinary income, not the friendly capital gains rates, but the highest rate she pays. At what will likely be a 22% bracket, she'll pay over $460,000 in taxes just on the withdrawals. But it gets worse. At age 73, the government forces her to take required minimum distributions, more money than she may need, pushing her into an even higher tax bracket and increasing her Medicare premiums. Her tax-deferred account became her largest lifetime tax liability. Then there's Jamal. He's 25. He contributes 6% to get the 3% match. He's told he's getting free money. But at 35, when he wants to buy a starter home, that $85,000 he saved is completely locked away. Taking it out means a 10% penalty plus taxes, a $25,000 haircut, free ox. He waits, missing years of housing appreciation. The free $4,250 match actually cost him access to capital during his highest opportunity years, and this repeats with inheritance complications, limited investment choices, and state tax traps. This is what we call the liquidity prison. It's a wealth storage system that charges you in fees, taxes, and lost opportunities for the privilege of locking your own money away. Let's perform a brutal audit of this. Let's call this person Alex. Alex is 30 years old, earning $80,000. He commits to contributing 15% of his salary, that's $12,000 a year, into his 401k until he's 65. He gets the standard advice: 7% average annual return. Over 35 years, that grows to a retirement balance of $1,895,000. That's the number on the statement. That's the number everyone sees. That's the dream sold. But we're not done. First, there's the hidden fee tax. The average 401k charges 0, 45% in administrative fees, and another 0. 65% if you're in a target date fund. That's 1% total. In a low-cost IRA, you can invest for 0.03%. That's a 107% annual drag that nobody talks about. The math on that is brutal. Instead of growing at 7%, your money effectively grows at 93%. Over 35 years, that fee drag costs Alex not thousands, but $412,811. Poof. Gone to nothing for paperwork and management. So our true balance is now $1,482,325. But that's the easy math. We all sort of know fees are bad. Now we have to subtract the future tax liability. Every single dollar of that $1.48 million will be taxed as ordinary income when withdrawn, not capital gains. If you're ordinary income, let's be conservative and assume Alex is in the 22% bracket in retirement. That's a future tax bill of $326,112. The government's share waiting patiently. So our after-tax value is now $1,156,213, but we're not done. Now we have to account for the opportunity cost of the lockup. What if Alex had taken that same $12,000 pre-tax contribution, paid the taxes up front, and invested in a regular taxable brokerage account? That start with about $9,600 after tax. He invests it. He pays only 15% capital gains tax when he sells decades later. Running that math, the final after-tax value in the taxable account is $1,579,375. By choosing the 401k, Alex didn't gain a tax advantage. He lost $423,162. The 401k underperformed a simple taxable account by over $400,000 behavior, and it gets worse. Then there's the darkest cost, the psychological cost of illiquidity. A Harvard study priced the liquidity premium, the value of being able to access your money, at 3% annually. Being unable to access this capital for a business, a property, or an education has a massive real cost. Let's be extremely conservative and say that illiquidity costs you just 2% in missed annual returns. If Alex could have earned 9% in more flexible investments, his $12,000 annual savings becomes $2,957,882 after capital gains tax. Compare that to the 401k's after-tax $1,156,213. So, let's add it up. The starting promise was $1,895,136. Minus fees, $412,811, minus future taxes, $326,112, minus the opportunity cost versus a taxable account, $423,162, minus the staggering cost of illiquidity, $1,869. That's not a typo. The 401k didn't create $1. $9 million in wealth. It cost Alex nearly $3 million in lost potential wealth. Think about that for a second. 40 years of discipline, 40 years of delayed gratification, and the system designed to help you retire comfortably actually robbed you of $3 million. And we haven't even touched on how this plays out for the average person. According to Vanguard's 2023 data, the average 401k balance for people aged 65 and older is just $255,150 after a lifetime of work. A 2,230 study from the Employee Benefit Research Institute found that 55% of workers aged 55 to 64 have less than 1 year's income saved in their 401k. Median balance, a terrifying $84,714. IRS data from 2021 shows the killer detail. 85% of retirees take withdrawals at tax rates equal to or higher than their working years, completely obliterating the "you'll be in a lower bracket" myth. Behavior. This means the overwhelming majority of people following the 401k playbook end up with less money than promised, and they pay more taxes on it. And before you say, "But Bobby, the employer match is free money," yes, it is. But a 2022 Boston College study found that 50% of retirees will see their standard of living drop despite decades of contributions. That match is like getting a free appetizer while you're slowly poisoned by the main course. Viewer, that's the equivalent of diligently filling a bucket your whole life, only to discover it has a hidden hole that drained half of it before you could take a single drink. This is where it gets really interesting. The 401k isn't broken by accident. It's broken by design. When you contribute pre-tax, you get an immediate dopamine hit of tax savings. That feeling makes you want to contribute more. The more you contribute, the more illiquid you become. The more illiquid you become, the more dependent you are on this single account for your future survival. The dependence makes you afraid to question it, so you contribute even more. It's a perfect closed loop. It's like one of those Russian nesting dolls. Here, you open the first doll tax savings, you open the second, compound growth. You get to the smallest, innermost doll, and it's just an IOU from the IRS. And here's what really gets me. The entire financial services industry relies on this. They profit on you not understanding that 1% in fees, 1.1% of the $7 trillion in 401k assets is $77 billion in annual revenue for them. They depend on you staying in their high-fee default target date funds. They literally budget for your financial illiteracy. When you start asking questions, when you prioritize a Roth IRA or a taxable account for liquidity, you become a bad customer for Wall Street. But you become the best CFO your life will ever have. The 401k industrial complex wants you hyper-focused on one question: what's my account balance? Because that distraction hides the real questions. What's my after-tax, after-fee liquid balance? And what opportunities did I miss to build real wealth because my capital was locked away? This isn't just bad psychology or sloppy math. This is predatory. This is designed. This is a scam dressed up as responsible citizenship. Now, I can hear the objections already. Bobby, my employer, gives me a 100% return on the match instantly. That's too good to pass up. And look, I get it. That seems like a no-brainer. But free money with strings attached is still controlled money. Take the match. Absolutely. But only up to the match. Then ask yourself, why would I voluntarily lock away another $17,000 where it can't be accessed for 30 years, will be taxed at higher rates, and cost 20 times more in fees? The match is the bait, not the meal. You might also be thinking, but what about the power of tax-deferred compounding behavior? Here's the problem. You're deferring taxes from your 22% bracket today to what will likely be a 25% or even 28% bracket in 2045, when we're finally paying for today's deficits. That only works if your tax rate plummets in retirement. For 85% of people, it doesn't. The problem isn't saving for retirement. The problem is using the wrong vehicle. Yourself, what do you actually do with this information? How do you escape the trap? Let me give you something practical. Strategy number 1, the liquidity ladder. This is about prioritizing your accounts based on accessibility, not just tax status. Liquidity has immense real value. Here's how to implement it. Step 1, build your 6-month emergency fund in a high-yield savings account. Step 2, max out your Roth IRA. That's $7,000. You can withdraw your contributions anytime, tax and penalty free. Step 3, contribute to your 401k only up to the full employer match. Get that free money. Step 4, put every additional dollar into a regular taxable brokerage account. Step 5, only after all that consider extra 401k contributions. For Sarah, the 32-year-old, this means instead of putting $23,000 all in the 401k, she does $7,000 in a Roth, $4,500 in the 401k to get her match, and $11,500 in a taxable account. She immediately gains access to $18,500 of her annual savings without penalty. Strategy number 2, tax diversification triad. Don't put all your eggs in the pre-tax basket. Pre-tax, after-tax Roth, and taxable money by retirement. This lets you control your tax bill yearly. If you're 45 and already have $300,000 in a 401k, stop contributing to it for a few years. Seriously pause. Build up your taxable and Roth buckets. At retirement, you can pull from your Roth to keep your taxable income low and then strategically sell investments in your taxable account at the 0% capital gains rate. You become the master of your tax destiny. Strategy number 3, the escape velocity account. This is a separate taxable account with one goal: to generate enough income to replace your paycheck before age 59 and a half. Calculate the gap. If you want to retire at 50, you need 9. 5 years of bridge income, multiply your annual expenses by 9. 5, that's your target. Build this in a taxable account with dividend stocks or ETFs. Once it's big enough to cover those gap years, you've broken the penalty barrier. You're free. But the biggest shift is psychological. You have to start thinking in terms of after-tax, after-fee, liquid dollars instead of just my 401k balance. You're not a 401k millionaire. You're a liquid half-millionaire with optionality, flexibility, and control. Here's what I want you to do this weekend. Open a spreadsheet. In one column, list every retirement account you have. In the next column, find and list the total annual fee percentage. In the third, calculate the future tax liability at 22%. In the last column, calculate the penalty to access it today. What you'll discover in that final number is your true accessible net worth. It will change everything. I want to leave you with one final thought. Retirement planning isn't really about accumulating the largest possible number. It's about maintaining sovereignty over your time and your choices. The 401k gives you the illusion of growth while taking the reality of control. We thought we were trading today's taxes for tomorrow's wealth, but we were actually trading today's liquidity for tomorrow's tax liability. Our grandparents had pensions, a guaranteed income stream where the corporation bore the market risk. We traded that for 401ks, uncertain balances where we bear all the risk, plus the fees, plus the taxes, plus the penalties. That wasn't financial innovation. That was a $1 trillion risk transfer from their balance sheets to yours. The people who actually thrive aren't the ones with the biggest 401k statements. They're the ones with flexible after-tax wealth they can deploy across a lifetime of opportunities. You can't eat pre-tax dollars. You can't use them to start a business at 45. Behavior, you can't lend them to your child for a down payment at 30. But you can build real, accessible wealth that serves your entire life, not just the last third of it. fact, you have permission to question the default path. The greatest wealth-building tool isn't tax deferral, it's optionality. You're not broken for feeling like retirement is always moving farther away, even though you're doing everything you were told. You're human in a system designed to keep you chasing. This journey is unfair. It's hard. But once you understand that every dollar has a tax destiny, a fee schedule, and a liquidity profile, you can build wealth on your own terms. If this video sparked something in you, share it with one person who's blindly maxing their 401k. Smash that like button and hit subscribe for more content that challenges how you think about money. Thanks for watching, and I'll see you in the next one.